Welcome to our session on raising smart money for smart investments for the next decade. We have a great panel and moderator with us. I'll do a quick introduction and then pass you on. Our moderator is Mr. Andrew Nimmo, partner of Watson, Farley and Williams, based in Singapore. On the panel, we have Kenneth Lam of Credit Agricole Leisure Shipfinance in Hong Kong, Julian Proctor of Purus Marine in London, Marcus Machin of Tufton Middle East in Dubai, Torkell Vold of Storm Capital Management in Oslo, and Vineet Puri of Citi in Hong Kong. So we're all over the world, but we're all listening to you. Andrew, over to you. Thank you very much.
Thanks very much, Kevin. Yeah, as Kevin said, we've got quite a large panel today, and we've got limited time. We've only got a 30-minute slot, and it is quite an interesting topic that we've got today. So we'll try to keep things moving along fairly briskly so that we can try and cover as much ground as possible today. So just to kick off and give a bit of context, I mean, one of the interesting things about shipping is it's always changing, as we all know. Looking at the current state of the market to try and give some context just before we launch into the questions. I mean, things are in one sense very much as they always have been. There's nothing new under the sun. Stronger tier one names in the industry are seemingly overflowing with capital at extremely competitive pricing. Smaller players are still, in many cases, struggling a bit in terms of finding good and affordable sources of finance. Particularly with so many of the traditional shipping commercial banks having withdrawn from the market over recent times. Just on that topic, and to give Kevin and Andrew a free plug, I saw there was a Marine Money supplement that came around by email yesterday that had some facts and figures on that were quite interesting, including one showing that there's been a 30% volume reduction in debt provided to shipping by traditional commercial banks since the GFC. So it just goes to show there's a huge gap there that needs to be filled, as we all know. And the question at seemingly every industry event in recent years has been, where's the finance going to come from to fill this gap for the next decade? Will it be private equity? Will it be specialist alternative lenders? Will it be lessors in the leasing industry? Will it be funds, bond market? There's so many options, and there's some new stuff coming through as well, as we've all seen. So we'll go on to discuss some of these options that are currently presenting themselves in the market, and as well as hopefully covering some updates and trends during the course of the panel. What's particularly interesting about the market right now is that in addition to the usual factors that we all have to navigate, there's a couple of things making things even more complex at the moment. One of which is the environmental and emissions regulations, which has been a big focus of this conference so far. And the second one being the COVID distortions in the market, of course, making it very difficult to compare year on year and see, get a true sense of what the underlying market is doing. So in this session, we're going to be seeing what the panel makes of all of this and where they see the opportunities in terms of investor demand and where owners can get financing on the best possible terms to suit their particular circumstances in the current market. So to start off by trying to get a quick overview of market direction, if I can ask the panel, if each of you were to highlight one key trend or theme in the current market in terms of sources of available funding for maritime assets, what would it be? And just to make it a little bit more challenging for you and not make it too easy, none of you can say sustainability-linked loans or ESG, because we've covered that already in many other sessions, and we're going to cover it a little bit later in some of the other questions. So if I can start with Kenneth, taking you in alphabetical surname order.
Well, good afternoon. It's very rare that my surname would come first, in alphabetical order. In this case, Andrew, you actually have covered some of the things I want to mention. We know the senior debt trend. Just a couple of the numbers. In 2008, if you look at the top 20 banks providing senior debt, it was 350 billion easily. And now at the end of last year is like 250 billion. So there's a 100 billion gap. It's very easy to say that they are just picked up by the leasing companies, in particular Chinese leasing companies, but it's not actually that simple. There are all sorts of funds that are stepping up, from governments, from ECA, policy banks, insurance companies, and tax incentivized investors. One trend we clearly see is that people used to be in the aviation space exclusively are now coming into shipping. it is very natural as a class of asset they want to invest in. But without further ado, I just want to say, the biggest trend these days, you can see there are actually more capital coming into the market, and it's really to make it smart. More expertise is called for in terms of structuring this capital, and try to bind the interests of the needs of the investors, the interests of the beneficial owners, and the needs of the underlying projects in terms of cost, in terms of volume, in terms of sustainability. I mean, not only the ESG part, but also how reliable this source of income is, and also matching the requirements of the investors and the underlying projects. And I would rest here for the time being. It's just meaning less senior debts, but there will be more structuring requirements, and this is the trend.
Thanks, Kenneth. So in your view, not so much a shortage of capital, but how to correctly allocate it and structure it.
Exactly.
You did, however, fail in your mandate not to mention ESG.
Sorry. Yeah.
Never mind. We can forgive you. Julian, would you like to go next?
Thanks, Andrew. Not surprisingly, I would echo a lot of what Kenneth said. I would add that the reduction in debt, which has been witnessed over the last 10, 12 years, has come at a point when you've got a lot of ship owners which are now counting their dollars and deciding where they're going to put those dollars, just by the fact that the dry and the container markets have done so well. So there's also been a lot more cash going around the system than probably in the past. So I think that's largely offset to a large degree the need to externally debt finance. I was on the phone to a banker in Switzerland yesterday who was saying just this, that even his medium-sized clients were ones which now had excess cash reserves, and not necessarily was it going to go into new builds. So, and this is coming at the same point when the new build order book, if we put aside what's happening in the container shipping industry, is really at a pretty low point. So there's a good matching between the conventional bank sources in terms of ECA, well-structured bank loans, and the fact that the new build order book is also at a low point. So it doesn't feel to me that we're out of balance. It in fact feels that we're very well balanced, that the bank debt which is available is being used predominantly for those projects, those new build projects, which are well structured. If I look at our business today, that's exactly where our capital comes from. It comes from ECAs, European banks, certain Asian banks, but it's all against new build projects. But with good contracts, in well-structured deals, it feels much more resilient, and we don't have the same speculative capital, I think, that we've had in the past. So I think we're in a much better place than we've been in for many, many, many years.
Those rumours of the death of commercial bank lending has been greatly exaggerated, you might say.
I think they're just finding their ways to the better quality deals, and that's probably not a terrible thing because it keeps the order book in check, and we have a much, much more stable market as a result. So it feels much better than I think in previous cycles.
Yeah. Marcus, shall we go to you next?
Yeah, I mean, I think points well made by both Kenneth and Julian. From our point of view, from Tufton's point of view, I mean, a characteristic of and perhaps as a factor also where I sit in the Middle East, characteristic of the sourcing of investment funds at the moment is just the increased regulatory burden and the difficulty of channeling funds through the fund structures to the actual projects, and whether it's AML, whether it's KYC requirements on investors, or whether it's the increasing burden of the economic substance regulations on the investment structures themselves. That probably is mitigating the volume of money which is coming in just for the time it takes to satisfy the requirements there. obviously within Tufton, we have a long track record of bringing institutional money to the shipping markets. And if I contrast what it was like and what it is like now, certainly we have a significantly harder task to actually deploy those funds. So I think that's it's a factor of how financial markets are working and how increasingly they're the shipping markets, which in the past have gone their own sweet way with almost a stateless approach. They're certainly not going to get away with that in coming years.
Yeah. And do you think there's an additional kind of eagerness to fund is part of the kind of globalized hunt for yield that we're seeing everywhere at the moment, thanks to interest rates being where they are?
Well, there's that factor, and certainly I had a certain amount of fun phoning up institutions I talked to over the years around the Middle East, who's ultimately said, no, we prefer aircraft finance, and we think that's a more stable market. I had a certain amount of fun doing that, phoning them and asking how it was going in recent years.
Vineet?
Yeah, Andrew. Yeah. In the interest of time, I won't repeat what my fellow panelists said, but I would just say that the way the capital structure of the industry has been evolving versus pre-COVID levels is something that is coming out very sharply, especially in the capital markets, where we see all the options becoming increasingly available to our clients. And how those options are being actually tapped into is something that I would pick up as a trend. And we're going to talk about some of these options as we go through today's panel.
And Torkell, anything to add, last but not least?
Yeah, with the last name being Vold, I'm always at the end in the sessions. But I think there is a kind of a new interest from institutional investors, and it's more interested in being a financier of the sector than actually a private equity owner of the sector. I'm thinking of BlackRock's buyout of Gaslog, Morgan Stanley buying Hög, and now KKR buying Ocean Yield. Certainly, I mean, Ocean Yield has been a frequent issuer in the unsecured bond market in Oslo. And they're not going to pay now 7-8% for unsecured bond. I mean, KKR has a lot of pockets for that type of money. And perhaps more interesting, Ocean Yield has been a darling among the shipping banks. I myself have been financing Ocean Yield when I was in ABN AMRO, and I think it's just a matter of time before KKR find other sources of also senior debt. For the leasing clients of Ocean Yield. That this is kind of a development that is going to be very interesting to follow, because we have seen it before in aviation and rail 20 years ago.
Yeah, so you think that's rather than being an isolated instance, that's going to be a start of a much bigger trend?
Definitely, it's going to follow the same trend as aviation and rail did, where leasing companies 20 years ago had 1/3 of the sector. Now they have three quarters, both in rail and aviation. And the elements of packaged senior debt into the institutional sector is among us. I spoke to a French bank last week, and they said that on the rail side we only have revolvers left. I mean, we have no loans.
All right, interesting. And do any of you see private placement debt deals coming into shipping as another developing trend and something that we might see more of? We've seen some already over the last 6-12 months. Do you think that's something we might see a little bit more of? Vineet, any comments on that one?
Yeah, sure. Happy to go first. And yeah, we are seeing this trend actually, and I'll mention a transaction which we recently did. So we recently helped Seaspan price $500 million sustainability-linked senior secured private placement notes, which happens to be the largest private placement in shipping, as well as the largest sustainability-linked private placement. And it helped Seaspan to tap into the longer tenor of the end, with the last tranche going up to 15 years. And the sustainability-linked angle also tied Coupons notes to the vessel decarbonization objectives, as well as Seaspan's corporate initiatives that results in coupon step-ups if they're not able to meet those on an annual basis. So we are seeing these kind of active discussions happening with our clients. I would think we expect this trend to continue, especially in the current times. Yeah.
I would add to that, if I may, Andy. There's obviously a proliferation of lenders, particularly from the insurance sector in Europe, and it's for a number of reasons, partially driven by regulatory capital. But what I think you see in those scenarios, these are really cash flow finance deals, which have a very specific focus and mandate. Big focus on offshore wind. Many of those big insurance providers, and we have a relatively large offshore wind fleet, they are really focusing on long-term contracts. You have an Equinor, or you'll have a Siemens, a GE, a Vestas. So an investment-grade contract, which ultimately they can tie back to a source which they find highly attractive. And I think there's no getting away from the offshore wind space. But the capital is incredibly low cost and long in duration. The other fact I would probably mention, because this is a panel for people trying to find niche sources of capital, it's very competitive in euros, not particularly in dollars, because again, these are pension plans with large euro assets and euro liabilities, I should say, trying to find good homes for their euro assets. So a lot less competitive when it comes to dollar financings. But it's a sector which surprised me, because even within the last 18 months, I think it's probably tripled or quadrupled.
Thanks. Interesting. I mean, we've been given the discussion topic today of raising smart money for smart investments, as you say, kind of looking for those kind of slightly more niche opportunities. So turning to where the panel thinks that the smart investments, if you like, in the maritime market are right now, and where is the strongest appetite from financiers and investors. I mean, clearly vessels with low and zero emissions and advanced clean fuel tech are top of everyone's minds at the moment. It would seemingly be the case that financiers are falling over themselves to throw money at this kind of asset. Is that the case really in reality when it comes to the crunch? I guess Julian, probably best placed to answer that one.
One of our best players I've got on my left and right, Kenneth and Vineet, which I think they have a phenomenal view on these matters. I can give you the view from what I'm seeing with new innovation, I think, in finance. And what amazes me is, again, the proliferation of new sources of capital being non-bank lenders, not the non-bank lenders we all associate with marine money in the past, which is generally they have high, expensive debt. But lenders that businesses like ours at Purus would look at, which, and obviously we have a phenomenally high quality business, being those lenders which are non-bank, but often are backed by state money. So you'll find some of the ECAs, in order to make themselves more competitive, are now backing private players to direct their capital. And that's happening in the Netherlands, it's happening in Belgium. But these are very regionally focused players as well. So there needs to be very clear green, strong angles, regional support, more regional focus. And there's a large amount of euros and dollars in duration which will be made available. And so for me, it feels as though the new source of capital are, again, not wanting to make this to do with sustainability only, but really focused on those opportunities which are green in nature, very green in nature, not kind of light green, because there's a lot of greenwashing. But also there's a strong regional focus. And that's the other realization that I'm starting to pick up on. There's an increasing regionalization of where the capital is beginning to flow.
Yeah, certainly on the sustainability linked stuff, that's been the case. We've seen much more activity on that front in Europe than in Asia until slightly more recently. It's really picking up now, and there's some real momentum behind it. But it's been a little bit slower, I think, over in this part of the world. But it is now certainly the hot topic. Probably more the E, as previous panels have said, in terms of obviously shipping is very fuel intensive and emissions are top of everyone's mind. So E is the big focus in terms of most of the KPIs. But we are seeing a strong trend in terms of players picking up more on the S and the G side as well, and KPIs related to things like diversity and gender neutrality and things like that. So there are quite a lot of new KPIs coming in, which I'm happy to chat to people about that after the talk if people are interested, because it is quite an interesting topic. Some of the bankers, are you seeing a similar trend in terms of broadening out of those KPIs on those loans, without going into this in too much detail, because I know there's other sessions dealing with it in more detail. Vineet and Ken, have you got anything on that?
Yeah,
maybe just quick. Sorry, Vineet, go ahead.
Yeah, thank you, Ken. Yeah, absolutely, Andrew. And I think it's a trend that is going to come on more, right? And I'll give an example why we think it's going to become more important from the entire ecosystem or supply chain perspective. If you look at an electric car or the manufacturer of an electric car, it cannot be called as a true net zero in simplistic ways, because it's not, as long as it's not using an eco-friendly car carrier or eco car carrier to transport those cars, it's very difficult to label it as net zero. So if you have a situation where you have like 3 shipping companies bidding for such a contract, the one which is able to supply an eco car carrier is obviously going to win, right? So we are going to see those kind of pressures from suppliers coming in more and more. And in terms of numbers, the sustainability linked RCF volume has been increasing drastically. August year till date, we see about $127 billion of transactions across 103 deals. And it's already surpassed 2020 number, which stood at about 87 deals valued about $97 billion. So we're seeing this coming up pretty fast. And you're right, S and G are becoming important. Obviously, E dominates about 55% of KPIs, but we also see S and G becoming more important. And our clients are also interested more in how they can look at these aspects from KPIs point of view. And I'm also agreeing with Julian. We are also seeing a push from export credit agencies that are having a greatest focus on ESG element, and as well as combining JOLCO together with export credit agency financing. And we are in advanced discussions to bring out some of these structures, which should be coming through pretty soon. But I completely agree with the panelists on this.
Kenneth, did you want to add anything before we move on?
No, just quickly, I just want to add that for banks there are KPIs, but we don't want to be the police of the world. We want to work with our clients to meet those objectives together. For example, just on the decarbonization, we want to move together, say, under things like Poseidon principles, that we can meet the decarbonization trajectory together. We want to work with our clients, work with the world, look at things holistically rather than being the police of the world. Yeah.
Yeah, absolutely, and that fits quite nicely with. I was talking to Torkell earlier this week on this, and it's not necessarily just a push from the financiers or the regulators. There is definitely a push coming from the owner and the charterer side as well. Torkell, you were saying you're seeing in particular a bit of a push coming from the kind of off-taker and end user side rather than just the owners.
Yeah, no, here up in the Nordics, this is high up on the agenda. I think the election of the sitting government was lost because of the environment 2 days ago. And, ship owners, they are good as well, but they are more focused on reporting and satisfying the banks and anticipating regulation and everything they have to deal with. Whereas the end users are concerned about the corporate image. The pressure to reduce the carbon in the value chain, public opinion, the brand, and regulation is going to lag, but public opinion isn't lagging. We see some new charters coming on stream offering 10-15-year charters, end users that we have never really seen being long-term takers of ships, such as, for example, Heidelberg Cement up here in Norway, offering 2 10-year contracts for dry bulk vessels with 0 emissions, and paving the way for a number of other large corporates. Not maybe familiar name to all of you, but companies like Veidekke, Coop, Skanska also having offered these very long contracts for new ships, basically, making sure that these ships are being built. So that's that is a trend that I think us as private debt investors are very concerned about, because at the end of the day, it's the end users we are after, or at least our clients, the institutional investors, they are after the end users.
I guess it's a consequence of the fact that ESG is one of those areas where it's not just a shipping focused industry. It's a global wide and crossing over every industry. So all the players are interested in building their credentials on that front.
Yeah.
Moving away a little bit from emissions and fuel stuff, and just thinking about other related technology, there's a whole range of other technology opportunities at the moment that aren't necessarily getting the same airtime, so far at least, and maybe not being as competitively fought over by financiers. Is there an opportunity there potentially, and what other technologies in particular would stand out to you with the potential for investment interest? Marcus, would you like to take a shot at that one?
Yeah, I mean, it's something which I've looked at pretty closely and am directly involved in as a director of two companies involved in application of all the buzzwords, robotics, artificial intelligence, communications technology. I mean, definitely from an owner's point of view, for a general ship owner's point of view, these are new challenges, probably developing from other industries, and in particular on the operating efficiency and maintenance costs, things of that sort, coming out of the oil industry, where partly because of the liability issue, but also because of the constraints that the oil sector has been under. There's such an emphasis. And that's where in the application of artificial intelligence into maintenance of the assessment of maintenance requirements for offshore structures, one of our companies, Abyss Technologies, has been very active. The other point, general point, is that huge amounts of data now being produced on board. To be useful, it's got to be communicated. So the communications technology and data compression, which Harvest Technologies is an industry leader in, is critical, and we see an enormous take-up of that. And when we were looking initially at the applications for ship owners, the standard for all the sensor technology and monitoring the engines remotely and doing all these things, the standard objection was, well, yeah, but we can do all that, but we can't actually communicate it. Well, you have to be able to, and you will be able to. And I see there's an enormous interest in those areas.
We have about one more. Sorry, and we have 1 more minute. So if there's just a last very quick comment from any of you, I'm afraid our time is up.
Okay. Anybody? Any final comments? We had so much more to say. We'll have to save it for the next time we can all get together in a similar session. It's a topic where there's a lot to say. Okay.
In that case, I'd like to thank you all, Andrew, and the panel for an interesting discussion. Hopefully, next time we meet, we'll be in person and we'll have longer to talk as well. Thank you very much for joining us today.
Thank you.
Thank you.
Thank you.